Calendar spreads and diagonal spreads are two powerful tools for traders who want to take advantage of implied volatility differences and time decay. But which one should you use, and when? In this video, we'll break down both strategies, show you how they're different, and help you pick the right one for your market view. The core idea of calendar spreads. A calendar spread is created by selling a near-term option and buying a longer-term option using the same strike price. You're betting the stock will hover near that strike as the short option decays faster than the long option. It's a neutral to moderately directional play, and your biggest edge comes from time decay and implied volatility expansion in the back month. Example: you sell a 1-month call at the 100 strike and buy a 3-month call at the same strike. If the stock sits near 100 when the short expires, you can profit as the long option retains value. The twist with diagonal spreads. A diagonal spread takes the same concept but changes one key element. The strikes are different. You still sell a near-term option, but you buy a longer-dated option at a different strike. This introduces a directional tilt. If you buy a lower strike call in the back month and sell a higher strike short call in the front month, you've built a bullish diagonal. Flip it around with puts, and you can structure it for bearish exposure. So while calendars are mostly neutral, diagonals let you express a directional bias with a time and volatility edge. Where implied volatility fits in, both strategies are all about managing implied volatility, or IV. Calendars benefit when front-month IV rises relative to back-month IV, or when the underlying stays range-bound. Diagonals give you a bit more flexibility. Since strikes are different, you're combining IV exposure with directional exposure. Here's the key rule of thumb. If you expect the stock to stall or consolidate, a calendar spread may give you the edge. If you expect a gradual move in one direction, a diagonal spread often makes more sense. Pros and cons. Let's break down the trade-offs. Calendars. Great for range-bound markets. Exploit time decay efficiently. Limited directional flexibility. Can lose if IV collapses in the back month. Diagonals. Add a directional edge. Still benefit from IV and time decay. More complex to manage. Riskier if the stock moves too far too fast. So your choice depends on whether you want a pure time IV play or a time EV play with directional bias. To recap, calendars have same strike, different expirations. Best for neutral setups with an IV edge. Diagonals have different strikes, different expirations. Best when you have a directional view and want to play the volatility curve. Both strategies give you an edge by exploiting the fact that near-term options decay faster than longer-dated ones. But the right choice depends on your conviction, neutral or directional. Thanks for joining us. If you learned something new, hit the like button, subscribe for more breakdowns, and drop a comment on which spread you prefer, calendar or diagonal.